Hey everyone, thanks for tuning in to episode 2. Per your suggestion, I have made some changes to the audio, so please let me know in the comments down below if it's any good or if I should make some further changes to the audio. So today I want to touch base on some of the basic information that you'll find when you look up a stock's ticker symbol. Then I'll be going over some of the things that I look for when I'm purchasing a new stock. And finally, I'll be going over the real estate segment of my portfolio and explaining some of the different types of stocks that you'll find in the real estate sector. So let's use Wells Fargo, ticker symbol WFC, as our example. So I'll go over this first section quickly because most of these things are self-explanatory. So the previous close is going to be the amount the stock closed at on the previous day, or on Monday it'll be whatever it closed at on Friday. So the opening will be the opening price for this trading period, so for this day. The bid is what people are willing to buy the stock for. The ask is what people are willing to sell the stock for. The day's range is the fluctuation for the day. The 52-week range is how much the stock has fluctuated over the last 52 weeks. The volume is how much money has exchanged hands of this stock, and average volume will be the same thing as volume but for the last 3 months. Now this is where it starts to get a little bit more tricky. So the market cap will be the total worth of the company if you take all shares into account. So let's do a little bit of math. So I looked up here how many outstanding shares does Wells Fargo have. So we can see here it's 4.1 billion. So if I pull out my calculator and I do 4.1 billion and I multiply that by 27.23, I can see that the total worth of all shares of Wells Fargo is 111 billion. So next, let's move on to the beta. So beta is an indicator for this stock's volatility. Any company with a beta below 1 will be less volatile than the general market. Any stock with a beta higher than 1 will have a greater volatility than the rest of the market. So next up are these two. So I'll talk about EPS first. So EPS stands for earnings per share. So if you take the total net income of the company and divide that by how many shares are outstanding, you'll get to this number, the earnings per share. So the PE ratio is the price to earnings ratio. So if I divide 27.23 by 2.89, I'll arrive to the price to earnings ratio of 9.4. So this is basically how much you're paying for the company. So next up is the earnings date. So part of being a public company where shareholders can purchase your stock includes some obligations to the Security and Exchange Commissions, or the SEC. Public companies have an obligation to file a quarterly report called the 10Q and a yearly report called the 10K. Wells Fargo will have their earnings call on July 14th and will subsequently file their 10Q for the second quarter of this year following the earnings release. So next up is the dividend yield. So you'll see that Wells Fargo, for each stock that you purchase, each share, you'll be receiving $2.04 every year. And the 7.46% is that number as a proportion of the stock price. So this is how much of your money that you're investing in this company that you will receive back as a dividend. Next up is the ex-dividend date. This is the date that you're going to want to own this stock by. So if you own the stock the day prior to the ex-dividend date, you are eligible to receive a dividend on this date. So if you buy the stock on May 7th, you will not receive a dividend. You need to own the stock the day prior to that. So next up is our 1 year target estimate. And this is what analysts are saying that this stock is going to be worth in 1 year from now. So with those basics out of the way, let's take a look at some of the signs that the company might be a good investment at the moment. Let's take a look at Fifth Third Bank, ticker symbol FITB. So this is a company that I'm going to be buying more shares of. And if you compare that to Wells Fargo, which is another company in that same segment, that I don't believe I'll be buying any more shares in the near future. So let's take a look at their financial statements. So if we take a look at Wells Fargo's revenue, they've been sitting around 83, 84, 85, 84, 82 over the past years in billions of revenue. So this is a company that's remained very stagnant in terms of what their revenues have been. Now, if we compare that to Fifth Third Bank, we can see that in 2016, they had a down year from the previous year, but they've been working towards increasing their revenue every year. So you see 6.8, 6.7, then in 2019, they have 7.8 billion, almost 7.9 billion in revenue. So let's take a look at some of the dividend statistics that I like to look at. So if we go on here, we can see that Wells Fargo has a dividend growth over the past 5 years of 7.3%. Now that's pretty good, but if we take a look at Fifth Third Bank, they've been increasing their dividend at a pace of 13% over the last 5 years. Now let's go to the financials so we can get an accurate measure of what is the payout ratio. So if we take a look at the payout ratio for Fifth Third Bank, you can see that they had a consistent payout ratio near 30%. Now, recently it's jumped up to 44%. And the payout ratio is a measure of earnings per share compared to their dividend payout. So as an example, you can imagine a company shouldn't be able to pay out in dividends more than it earns. So as this number approaches 100%, this becomes more dangerous of a company to invest in terms of them cutting the dividend or getting rid of it altogether. So if we take a look at Wells Fargo, you can see that their payout ratios have consistently been 40 or above. And more recently, they've been at 67%, which at this point, it's getting into the territory where I would consider this dividend not safe. So if we compare that to Fifth Third Bank, Fifth Third has been increasing their dividends. They have more room to grow that dividend than Wells Fargo does, and they've been consistently increasing their revenues. Wells Fargo has remained relatively flat in terms of revenue. With that being said, I'd like to turn over to my portfolio and show you guys some of the companies that I've selected in the real estate sector. Before I go over my case for all these companies, I'd like to explain how the real estate sector works. Most companies in the real estate sector are what are called real estate investment trust. Real estate investment trusts are different from most companies in the stock market because they are flow-through entities for tax purposes. What this means is that REITs do not pay taxes, and in exchange for these benefits, REITs are required to pay out 90% of their taxable income to shareholders in the form of dividends, or more accurately said, distributions. Distributions, while being almost synonymous with dividends, are taxed at one's ordinary income, the same rate your regular income you earn from your job is taxed at. REITs can be divided into two segments: mortgage REITs and equity REITs. Equity REITs are companies that buy real estate property and rent it to tenants. Mortgage REITs are companies that buy mortgage contracts and typically profit off the difference between the interest they are charging the property owner and the interest they are incurring on the money they used to borrow to buy that mortgage. As you can see, Mortgage REITs are much more complicated in nature than an equity REIT would be, but oftentimes they yield higher dividends than equity REITs. Mortgage REITs can also perform other functions such as origination and securitization. Origination is when the company goes out and creates new loans through people like you and me buying a home. What companies that focus on origination do is they factor their receivable. Factoring in its purest form is taking a loan over its life that will produce a mortgage company $30,000 of interest income, and then that company will sell it to another company for $20,000. So you made $20,000 off that loan, and the other company will make the other $10,000 over the life of the loan. So basically, you are securing cash and you are letting another company earn the rest of the interest on that. Securitization, also called servicing, is the act of charging a fee to other companies for collecting payments on their behalf and ensuring that the terms of the loan are being met. The danger of securitization is even if a tenant does not make a payment, you have the duty to make sure that the company you're offering your services to is paid in full. This is why mortgage REIT prices have plummeted as a result of the Rona, due to the fear of tenants not paying their mortgages. There is a lot more I'd like to cover, such as agency mortgage-backed securities and non-agency securities, but I think I've covered enough of the real estate sector, and I like to cover some of my picks. O Realty Income Corp is an equity REIT, and it's one of the companies known for having some of the largest brands in the business as its tenants. They pay a monthly dividends and have been regarded as one of the most stable and profitable companies in the sector. NRZ is a mortgage REIT. NRZ is a company that has sold a great chunk of their debt to improve their liquidity. They're increasing their focus on their origination business and look to be taking steps in the right path to recover from the current pandemic. LTC Properties is an equity REIT that focuses their purchases in the senior housing department. Being that seniors are further affected by the Rona, they have seen significant decreases to their stock price, making this an attractive company to buy. LTC also pays a monthly dividends if you guys find that to be a bonus. SPG Simon Property Group is an equity REIT that focuses on shopping malls. Being one of the most highly affected market segments, SPG's price has plummeted due to the pandemic. Lastly is MITT, AG Mortgage Investment Trust. As the title may give away, this is a mortgage REIT. This might look a little strange that I'm up $926 in this stock when I only own $40.21. I bought this stock because it was lagging the market on the recovery, which is something I always like to invest in. When I see a company that is trailing its peers in recovery, I like to purchase that company. So I purchased this company on Friday, and on Monday I sold it at double of its stock price. So when I see a company that has a massive recovery, I like to lock in those gains. I purchased $1,000 worth of stock of this company and sold most of my investment at a 98% profit. And sure enough, this company is almost back to the price I originally purchased it for. So with that being said, I'd like to end today's video. Leave any questions you have in the comments, and thank you for watching once again.